So my client just got a 2.75% interest rate in 2025. And let me share with you how I was able to do that through Assumable Mortgages. Throughout this video, I'm going to tell you the benefit, the costs, and the risks of an assumable mortgage and what most realtors aren't telling you. So I got into real estate about 2.5 years ago. And one of my very first clients asked me like, hey, Kaleb, why should I buy this $850,000 house? Rates are at 8%. And to be honest, I had to look at him and say, like, I don't know if that's a great investment. The market is at its very peak. Rates are at its very peak. I don't know what rates are going to do over the next year. And that actually started my journey into creative financing, looking into assumable mortgages, looking into subject to seller finance. Anything that I could do to get that payment lower, to get that interest rate lower, that's what I was looking for. So let's get into it. Super quick, an assumable mortgage is when you take over an already existing loan. So if somebody bought back in 2020 and they have a 2.5% interest rate, if they have a VA, FHA, or USDA loan, you're able to take over the payment, take over the interest rate, take over the time in the loan that they're in. So, they only have 25 years left to pay off that loan. So you start at that 25-year mark and you only have 25 years left. Conventional loans aren't traditionally assumable because of the due on sale clause, which we can get into in another video. For the FHA loan, if you're a credit-worthy buyer, any loan past 1989 is now deemed assumable. Anybody can assume a VA loan, but there's plenty of risks that go along with it. If somebody assumes a VA loan and they don't have their entitlement, the seller actually loses the ability to go purchase a new VA loan. So it's very important to be cautious of who you're allowing to take over your mortgage. Similar to a traditional mortgage, you're still gonna have to qualify. You're gonna have to prove that you're making enough income, that you have a debt to income ratio that is within the guidelines. You're gonna have to prove that your credit score is above a 580 at least in order to get the loan. The higher, the more chances of an approval. And then they still require for the FHA and VA for it to be a primary or secondary residence. So this isn't an investment opportunity, but it is a way for you to upgrade, downsize, move to another area without changing your payment and securing that low interest rate. When it comes to the closing costs on a VA loan, they're actually much less than if you were to go get a traditional mortgage. Normally it would be around 2.5%, but closing costs for the VA loan are only 0.5%. You also don't have the VA funding fee because that's already been paid for. So that 2.15% add-on to the loan balance is no longer going to be applied. If you end up having somebody who's not military affiliated and they decide to assume your mortgage and you're okay with it and you let it happen, you will have to sign a release of liability in order to actually move forward on this, since you are relieving your entitlement to go purchase another VA loan. The biggest issue we're gonna run into is the gap. So basically, if the loan balance is at $500,000 and they're selling it for $700,000, that equity gap of $200K, we're gonna have to come in with the difference. We're gonna have to front them the cash. Here's your $200,000, here's your equity. Let me take over your mortgage, take over your payments and the interest rate. If you don't have all of the cash, there are ways to get around it. Way number one would be through getting a HELOC or a secondary loan. With those, with my lenders, you are generally gonna have a minimum of 10% down. So for that same example, you would need $70,000 down and the bank would cover the $130,000 difference. Typically, they're going to be a higher interest rate, 8 to 10, sometimes up to 12%, depending on your credit. We can still make that pencil, but a lot of the time it ends up increasing your monthly payment to more than what a traditional loan would be. And so it's not necessarily always worth it, but we can run the numbers per deal. The other way we could also navigate it is if we have a seller carryback. The seller is actually able to build out an agreement with you to pay them that remaining amount. So for instance, on that deal, $700,000, $500,000 loan, you come in with $100,000, there's another $100K left over. Maybe the seller is willing to front you the money and create a loan on it so that you are now owing the seller an additional $100,000. We can build out that agreement however you and the seller agree upon. whether it's a flat rate per month until you hit it, maybe it's a smaller amount with a balloon after 5 years, but that's something that we could always dive in if we're not able to front the cash on the deal. A quick little step-by-step when it comes to the assumable mortgages is first we have to find the property. So I can look in the MLS and I can find properties for you. I also have a website that I'm partnered with, Rome.com. They're a great website that shows all of the assumable loans within an area. And they do have rough calculations on it. It's not always 100%, but it gives you a pretty good idea of the monthly payment and how much you have to put down. Once we actually find the property and we write an offer, we get the offer accepted, the seller is now going to have to go to the servicer and request that the servicer reaches out to the buyer stating that they're going to assume the mortgage. They're going to have a packet that they're going to fill out. Then the servicer is going to go to the buyer and send them a packet to also fill out. And that process right there is going to be about 2 weeks. During that time, we're still doing your traditional inspections on a typical escrow. Your inspection, your disclosures, reviewing it, termite report, all of those things are still required within the escrow. The only thing that's actually not required within the escrow is an appraisal. Most of the time they won't even require an appraisal because of the loan to value ratio. If you want to get an appraisal, you're more than capable of doing it. And sometimes the bank will also do an appraisal, but it doesn't actually affect the sale. Once the buyer finishes the assumption package, we send that package into the underwriter, and the underwriter is going to confirm all the information, the fees, the costs, and that buyer is actually eligible to assume the loan. This actually takes the majority of escrow. So because the servicer is not really making any money on the deal, they don't actually really have any incentives to move quickly. So most of the time what I've seen is it's going to take 30 to 45 days for them to complete the application and fully underwrite it in order for us to move forward. So just be patient with the timeline. It's not really up to us. Once they approve the loan, we solve the issue of the gap, whether you have the cash coming in or a secondary finance. We can bring in the secondary financing. I have lenders local. Your lender probably does it. With Rome.com does it. So there's plenty of loan options, and I'd always recommend to get at least 3 opinions. Then we're going to close on the property, notarize all the documents, and send it out to the county to record. The loan gets transferred into your name. So when you sell a property via Assumable, there is no tie to the property unless you had done some sort of seller financing to cover the gap. And I did quickly just want to go and give you an example of one of my clients and what we were able to do for him in 2025. If you want the exact details on it, we can always book a consultation and I'll show you the paperwork. But for privacy reasons, I'm not going to just blast it on media. So my client bought his first home in 2020 in Temecula. He got a 2.75% interest rate. It was a 1,400 square foot, 3-bedroom house, and his payment was only $2,800 a month. My client has 4 kids, his mother-in-law living with him, and his father. So you cram that many people into a small 3-bedroom, 2-bathroom, it's gonna feel really tight. I actually happened to cold call him and we had a good conversation. He told me, I would love to move, but I can't afford it. And that's when I was able to pivot to Assumable Mortgages and show him what's possible. So we were able to move him into an $800,000, 3,400 square feet, 6-bedroom home with another 2.75% interest rate. We were able to take his equity of $215,000 and we put down $170,000, which was required to purchase the property. And the payment on the new property was only $3,800. And I'll admit, $1,000 increase, that is a big increase, but when you compare it to what it would have been with today's traditional interest rates, his payment would have been $4,900 per month. So my client's saving $1,100 every single month. He's saving over $12,000 every single year, because he was able to take advantage of assumable loans. If you've been thinking about making a move and you're interested in exploring these options, schedule an appointment in my Calendly link below. We can go over your needs, your wants, and your wishes, and I can build out a plan that would make sense for you, and I can get you into that new property without increasing your payment too much. Again, if you have any questions, drop them in the comments below. Hopefully we get to talk soon, and I hope you have a blessed day.